Hi folks, and welcome to this video on part 2 of our problem. Here we are going to continue with the palm and storm problem. The only thing we're going to do is we're going to adjust it to assume that if that P had used the equity method to record its investment in the sub, and then in the second part we're going to prepare a consolidated statement of changes in equity for the current year. So now if the parent company had used the equity method to calculate the value of the investment in S, it wouldn't be at cost. Remember, the original cost of this investment was $350,000, and that was back at the beginning of, or the end of year 2. Don't forget, we're now into year 6. If P had used the cost method, they would still be showing that at that investment in S at the same value that they bought it at, which is $350,000. We know that under the equity method, the investment account changes. How will it change? For any equity the parent has picked up since the date it became related to the sub, and it would pick up its share of the sub's increased equity. In our case, what do we know? We know, first of all, that none of the equity all the equity increases have happened as a result of changes in retained earnings. So any changes in retained earnings have increased or changed equity. There's been no new shares issued by the sub, so there was no change in shares that created any change in the equity. So it's all related to retained earnings. So how are we going to calculate that? Well, there's two methods. I'm just going to do this second one here first based on what I just told you. If we started at $350,000, we know that any adjustment to this investment account on the parent's balance sheet, if we'd used the equity method, would have been due to any of the post-acquisition adjusted retained earnings of the sub, meaning any of the retained earnings adjustments since the date we became related to that sub. So what new equity has that sub earned? It's all going to be in its retained earnings. And you remember from step 5, when we calculated our consolidated retained earnings balance, we had that number, right? We said that the post-acquisition adjusted retained earnings of the sub at the date for which we're calculating the investment in the sub account, which is at the end of year 6 on P separate entity balance sheet, we know that's $78,850. If we take our share, that is our share of the post-acquisition adjusted retained earnings of the sub. So all we need to do in essence here is add that to the investment at cost in order to get $413,080. That's one way to do it. The other method that we used in class is to use the NCI value that we calculated way back in step 6. Why? Because don't forget what the NCI represents. It represents their share of the sub's fair value. So if I took my NCI that I calculated in step 6, which is $103,270, and divided it by 20%, that number here, 103,270 divided by 0.20, would give me 100% of the fair value of the sub. I'm not looking for 100% of the fair value of the sub to adjust the investment in the sub account under the equity method. I'm looking for changes in that investment account. I'm picking up only my share of this amount here. So if I multiplied by 80% to get my share, that also gives me $413,080. So either of these methods would work to help you calculate the investment in the sub using the equity method at the balance sheet date. Now, the second part we asked you to do is to prepare a consolidated statement of changes in equity for year 6. So we reviewed in class the format of that statement right here. We would start with the ordinary or common shares, retained earnings, and NCI. Notice these are all accounts that are included in the equity section of P's balance sheet. And then we're going to get a total. Normally we would do the statement of changes in equity before we do the consolidated balance sheet. You learned that in your prerequisite course. But in this case, we're doing it afterwards. So in any case, in order to find out the opening balances here for the consolidated balance sheet, we would know that the ordinary share balance must be the balance that the parent has on its separate entity balance sheet. Why? Because on the consolidated balance sheet, don't forget we're doing that consolidated balance sheet for the benefit of the parent's shareholders, not the subs. So the parent shareholders are only interested in the common shares outstanding that are their shares. So that would be straight from P's separate entity balance sheet. The consolidated balance of retained earnings at the beginning of year 6, we don't know. We're going to have to calculate that, as well as the opening balance of NCI. Now don't forget, we are calculating opening balances at the beginning of year 6 because we want to know what the changes in equity were from the beginning to the end of the year, right? So we're doing it for year 6, over the year. So what would have changed the ordinary share balance is any new shares that were issued, in which there were none. What would have changed the retained earnings balance is any net income that got attributed to the parent's shareholders in year 6, right? And any dividends declared by the sub, or by the parent, I should say, to its shareholders in order to give us the ending balance of retained earnings. For NCI, we are going to have to calculate the opening balance of consolidated NCI. We don't have that balance yet, but we know the amount by which NCI grew. It grew by the amount of consolidated net income that got attributed to the NCI shareholders. So when we did our step 3 calculation on calculating consolidated net income, we calculated that number. So we have that. And then we have dividends that were declared, okay, by the sub to the NCI shareholders. And we also know that because we know in this question that the sub declared in year 6 $24,000 in dividends. If 80% went to the parent, then 20% must have gone to the sub. So we can then calculate our ending balance of NCI. So now I would like you, even though you know the ending balances on the consolidated balance sheet for NCI and retained earnings, this would be a good way to see if you could calculate the opening balances for those two accounts, to see if it leads you to the number you already know you should get in the ending balances for those two accounts. So now let's start our calculation. Just to complete this statement here, to complete all these guys, find the opening consolidated retained earnings balance and the opening balance for NCI. Well, in order to calculate the opening balance of consolidated retained earnings, we normally would start with the two separate entity amounts, and we're not given that because they didn't give us a statement of retained earnings. But we can calculate it because we know the separate entity retained earnings for each entity at the end of the year, P and S. We also know the dividends that each company, each entity declared during the year. 40,000 for P and 24,000 for S. That was given in the question. And the question also gave us income for each separate entity. In the income statement, 108,000 for P and 62,000 for S. So if we worked backwards, we would be able to find the number such that when we added income and deducted dividends, gave us the ending retained earnings balance that we see in each entity's separate entity balance sheet. And so if we did a plug for the opening values here, we would find that the opening retained earnings for P is 82,000 and for S is 152,000. So we can calculate the opening balance of consolidated retained earnings in a similar fashion, in that we can use the same method we used to calculate the ending balance of retained earnings on the consolidated balance sheet in the first part of the question. We can start with the separate entity retained earnings of P and add to it the adjusted post-acquisition retained earnings of the sub. The sub's retained earnings, again, at the beginning of January, and don't forget we want it at the beginning of January because we're trying to find this number right here, retained earnings consolidated at the beginning of January. So we can use 152,000, which is what we just calculated, deduct the acquisition retained earnings because that represents the retained earnings of the sub that the parent didn't have a hand in earning at the date they became related. So we're going to get post-acquisition retained earnings of 88,000. But don't forget, we had also adjusted retained earnings or adjusted income each year from years 3, 4, and the entire year 5. In step 2, we gave you those amounts. Cumulatively, we made adjustments every year to the sub's income that totaled over a 3-year period 25.5. So if we're not sure about that, we can go get that in step 2. So let's go back and see if we can reconcile this 25.5 I'm giving you. Go back to step 2. We know that every year for years 3, 4, and 5, we increase the amortization expense or depreciation expense on the plant assets when we amortize the acquisition differential or the fair value increment $5,500 a year for 3 years. We also know that we amortize the trademark for an additional $3,000 a year because of this $36,000 increment. So we've been making adjustments of $8,500 a year to the sub's income for years 3, 4, and 5 each year for 3 years. So cumulatively, that adjusts retained earnings, all right, by 25.5, right? 8,500 times 3. So you have to kind of envision in your mind that every year that we did our consolidated income statement in year 3, and then in year 4, and then in year 5, all of those consolidated income statement accounts would have got closed out to consolidated retained earnings. So because we're starting at the beginning of year 6 with each separate entity's retained earnings, we don't see those adjustments there. So we have to adjust the separate entity balance that we have for the parent or for the sub by the amount to change it to a consolidated figure by making those adjustments in our calculation. So if we deducted all of that extra amortization that we took, we'd get post-acquisition adjusted, again adjusted for the cumulative acquisition differential amounts and any impairment losses we have, which don't forget, up to the end of year 5 we didn't have any impairments, but if we did, we'd include them. Our adjustment year of 25.5 gets deducted from 88,000, so we have post-acquisition adjusted retained earnings of the sub of 62,500. But don't forget, we only take our share, which is 50,000. So we wind up with consolidated retained earnings at January 1 year 6 of 132,000. So that is going to be our opening balance for consolidated retained earnings at January 1 year 6. Now, to complete the first line of the consolidated statement of changes in equity, let's have a look at calculating NCI at the beginning of the year. So what does that turn out to be? Well, let's use method 1. We know that NCI at any point in time is the NCI share times the book value of the sub at the date for which we're calculating our NCI plus the unamortized acquisition differential at that same date, January 1 year 6. Well, we know the book value of the sub at January 1 year 6. It's the sub's retained earnings plus its common shares. Now, don't forget there were no new common shares issued since the date we became related. So we can use the common shares that are sitting on the separate entity balance sheet of the sub, which is 240. So that's our book value of the sub at January 1 year 6, 152 plus 240,000. And our unamortized acquisition differential at January 1 year 6 is what? Well, don't forget, if we went back to step 2, we know from step 1 that our total acquisition differential was 133.5. To the beginning of year 6, i.e. the end of year 5, we amortized 25.5 of it. So unamortized is 108. So if we added these numbers in the brackets and took 20% of it, the numbers in the brackets add up to what? 500,000. At 20% gives you 100,000. So if we were now doing the statement of changes in equity consolidated, we have the consolidated retained earnings at January 1, the NCI on the consolidated balance for NCI at January 1 year 6, and then our ordinary shares, again, we said earlier, just those of the sub, right? Of the parent. And the parent didn't issue any new shares all the days they were related to the sub. So we take what we know they have in their separate entity balance sheet at the date we see, December 31st, year 6, because there was no change in the ordinary share balance during the year. So what they ended with at the end of year 6 is what they started with, right? So we know we started off with 772,000 in consolidated equity. What changed that during the year? The parent's share of the consolidated net income, which we calculated in step 3, and NCI got adjusted for the amount of its step 3 attribution of income. Don't forget now, the retained earnings consolidated also changed by the amount of dividends declared by the parent to its own shareholders. Don't forget, this consolidated statement of changes in equity is being prepared from the perspective of the parent shareholders. So they're only interested in seeing dividends that were declared and paid or declared to their shareholders. And we know that sub, don't forget NCI or shareholders in the sub, the NCI was allocated $4,800 of that $24,000 that got declared by the sub in dividends. So now we're deducting the NCI share because any declaration of dividend to the NCI reduces the obligation of the consolidated entity to the non-controlling interest shareholders. So we can see now that our ending balance of retained earnings is $213,080, which we calculated in the first part of our video. And we also have $103,270 as the ending balance. So you can see here, if we add across, right, we have numbers in each of these columns, in this column, right, which is going to give us $856,350. Or we can add the columns here and come up with the same row total and column total, which is $856,350. So this concludes our video on our question. I hope you found it valuable.